Netflix Inc., ticker symbol NFLX, is currently trading at $336.78 a share. It is up almost 15% on the year today, but if we take this stock a little bit further back, you can see it is down massively from its all-time highs at around about $690 a share. It's had a very, very good 2022 once it's recovered, and it's recovering again in 23. Can it get up to the previous amounts? That's the answer we're going to be looking for today. Also, they have their earnings coming up on the 18th of April, so make sure to check that out. I'll potentially be doing a video then as well. But what we're going to be doing is looking at my automated stock valuation spreadsheet. Check out Patreon, the links are in the description. But what this is my automated sheet where we'll be looking at the stock information, the financials, looking at the valuation of the stock using discounted free cash flow, the Ben Graham model, and the comparable company model to see the fair value of Netflix. So let's have a look at the stock price. As I said before, it was down from $690, almost went down 75%, and has then had a strong rally up about, well, once again 80%, but currently settling at $336. If we compare this stock to the S&P 500, over the last 5 years, you can see that actually Netflix has been soundly beaten by the market due to the massive drop-off it had in 2022, up almost only 8% in the last 5 years, where the S&P 500 is up 54. And if we look at the last year, once again, pretty similar, 2 and 6%. And the last year to date, Netflix is slightly beating the market with 14 to 7. Now, if we were to see that point when before the stock price dropped, you can see that Netflix was easily beating the stock at around about 100% gain in that time. Now, let's have a look at my automated stock valuation spreadsheet. So we'll add in the ticker Netflix, and what this will do is we'll load up all the financial information on the company. So as I said, $335 a share, market cap of 150 billion, PE ratio a little bit high, 36.86. The market average is around about 22 at the minute. Earnings per share $9.14, and a beta of 1.27, which means it moves slightly more volatile than the market. They do not pay dividends, so we'll be not talking about that. So firstly, we want to have a look at revenue, and revenue is increasing. And yes, it's doubled since about 2018, 16, 20, 25, 30, 31.6. So revenue is increasing pretty steadily, but slowing. Then we want to see if the net income is increasing. This is the profit. And yes, it's gone from 1.2 billion to 2 to 2.8 to 5.1, and then down in 2022 with 4.5, but still overall, it has been increasing. Now, what are they doing with their shares? Are they buying them back or issuing more shares? Well, you can see they're actually issuing more shares, 436 million to 445, and they're issuing very, very slowly, about 1% each year. So what does this mean? Well, they are diluting shareholders, because if there's 10 shares in the company and you own one, you own 10% of the company. If they then issue 10 more shares, there are now 20, you would then only own 5% of the company. Now, normally that is bad, but as the stock price has been steadily rising, they have been issuing shares when the stock was at a higher point. So they were issuing shares when it was back $620 a share. Now, obviously, that's dropped down quite a bit. You would like to see them buying them back at this point, but if they're issuing the shares when the stock is, overvalued, then they're able to reinvest the capital and hopefully grow the business. So not always a bad thing. Now we finally want to look at the free cash flow, and you can see free cash flow is pretty much all over the place, but currently it is in the green, 1.6 billion in terms of free cash flow. So what can they use for this? Well, they can reinvest it in the company, use it to pay dividends, things like that. But we can see it was negative 2018, 2019, 2021, positive 2020 and 2022. So that is quite good. So firstly, we are going to be looking at discounted free cash flow model. What this does, well, based on the revenues and the net income, we calculate the future free cash flow. We calculate estimates on revenue and net income, and then calculate the future free cash flow and discount them to today's value. So based on the averages that we have above there, it currently has the stock price at -70. So obviously that is not correct. Let's have a look at some of these numbers. So firstly, the revenue growth rate on the averages, based on the averages, is about 12.6%. So I think this is a pretty fair amount. In fact, this is because of 2022 has decreased. So basically, when we can see the earnings, we can review this, but I think this is about a fair estimate right now, because obviously Netflix has been consistently growing. Net income margins. We look at this. I think this number is a little bit low, actually. Let's bring this up to about 14.21% as the most recent number. And then finally, net income to free cash flow. So because of the negative free cash flow numbers before, this is all out of whack. So if we take the 36%, which is this number here, this would have the stock at a $60 price because of the low free cash flow here, 2 billion, 2.3, etc. If we then increase this a little bit, let's go to 70%, which is the 2020 number. It does put it at $115 a share, but is a far cry away from the 336. If we were to get a number in terms of free cash flow, what would give it a fairly value? Oh, that's a little bit on the high side. Let's go 250%. Oh, okay, that's a bit higher as well. We'll go 200. There you go. That's about fairly valued as it is. So they would need to be generating at about 11 to 14 billion in the next few years in free cash flow. That would put it at about fairly valued. Currently, they are not even 2. So that is not a buy according to discounted free cash flow model. Next, we want to have a look at the Ben Graham model. What this is it looks at earnings per share, the growth rate of a non-growth company, times the corporate bond yield, times by the average. So let's have a look at the current corporate bond yield right now, 4.6%. We'll update that right now. And then we also have a look at the analyst expected growth rate for Netflix. So if we go to Yahoo Finance and scroll down, we can see that the next 5 years they're estimating is around about 16%. Now the past 5 years was 32, so we're going to actually compare both of these numbers here. So we'll put in the 16%, and that would actually give Netflix a fair value of $216 and a Graham price of 162, which is kind of a buy and hold price. So overvalued based on their next 5 growth rate. Now, if we look at the previous 5 years and they were able to match that once again, well, then that would actually put it at around about $360 a share and a Graham price of 275. So if they were able to match the previous 5 years growth with the next 5 years, then obviously it would probably be a buy, but that will be very, very hard. Just actually before we do that, this is the Netflix subscribers. From 2013 to 2022, so you can see the big growth they had over the last few years, and it is slowing slightly. We have had a couple of down quarters, which we previously didn't have. You can see the first down quarter was 2022, and they had back-to-back there again, but they had a big jump up in the fourth quarter of 2022. So really, this next number will be quite big. Obviously, if they don't beat the previous number, that'll be bad for investors. If we compare that to something like Disney had massive growth since 2020, from 126 to 146 million, but then did have a down year in the first quarter of 2023. So Disney have had a down year, then you would kind of expect Netflix to have something similar. But let's continue with this. We'll have a look at the comparable companies model. What this does is it looks at the metrics here: EV to revenue, EV to EBITDA, and PE, and then based on these, we'll give based on ratios, we'll give the fair value of the stock. So we'll have a look at some comparable companies. Obviously, there is not one that's really like for like exactly, because one company I would like to compare to is obviously Disney, but the problem is with Disney, obviously it has a lot more going on. So also another company that is similar is we'll go with Roku. See if Roku has stuff. Unfortunately, not profitable. So I will not look at these, which is kind of puts a good line on Netflix, because obviously it is profitable. We'll go for WBD, which is Warner Brothers Discovery. Once again, they are not profitable. I'll take this out at the end, and we'll just go with these two at the minute. Let me just delete this row. So what we want to see is lower ratios here. Now, EV to revenue, Netflix actually has the highest. EV to EBITDA, it is about in the middle. And PE ratio, well, it is lower than Disney. So if we look at these numbers here, that would put it at $208 a share based on EV to revenue. But EV to EBITDA, you can see it is slightly undervalued. Now, we'll just do a direct comparison with Disney, because these are the ones profitable. Well, there you go. That is quite interesting, actually. EV to revenue, obviously, it's a lot higher. That puts it at 227. EV to EBITDA and PE ratio, it is a lot lower, and actually has this at 500 and 400. So if we take an average of these, it actually puts it at $404 a share, which would actually be a buy in terms of a direct comparison to Disney. So comparable model says it's a buy compared to Disney. Ben Graham formula says it's not a buy, and the discount free cash flow says it's not a buy. But I think this is still a very interesting stock, and obviously seen by the fact that this was previously trading at almost $700 a share. Right, guys, thanks for watching. Please give a like on the video if you enjoy it. Subscribe if you're not already, and I'll catch you guys next time. And I can't find the record button. Stop. There you go. Bye.